Thanks so much for joining us today for First Insight's webinar, Pricing Power versus Brand Trust, a Tariff Era Dilemma. Our discussion today is structured around First Insight's latest report, Tariffs and Trust, Why Retailers Risk Loyalty with Price Hikes. This report surveyed over 3,000 consumers and 300 retail executives about pricing, tariffs, and the potential impact on customer trust and loyalty. You can download the full report at firstinsight.com. Our speakers today are First Insight CEO Greg Petro and CFO Jim Gruskin. Greg Petro is the founder and CEO of First Insight with over 30 years of experience in sales and management within software and retail. He has been recognized as one of the most influential people in retail by the National Retail Federation and Entrepreneur of the Year by Ernst & Young. Jim Gruskin has spent 30 years as a corporate executive, investment banker, and investor, leading strategic and capital raising transactions as both an advisor and principal. In addition to his duties as Chief Financial Officer for First Insight, Jim also serves as managing partner of Cobb Bay Partners, which has advised companies and investors across multiple industry sectors. And now, Greg, Jim, take it away.
Well, it's super excited to be here. We're here today to talk about tariffs, something that, only a handful of people have been talking about. I jest, of course, that is the topic of the day, of the week, the month, and I think probably this year. So let's spend a few minutes. We've done some research here at First Insight. Let's spend some time talking about what we found on that. Before we do that, though, let's talk about the agenda for today's conversation. We're going to talk about the current state of the economy. You have a deep background expertise in the financial community. I welcome your thoughts on that. We'll talk about the things we learned in our study, some of the interesting facts that the data reveals, and then look at a couple of case studies, how companies are reacting today and how they should be reacting. And then we're going to wrap it up with thoughts and suggestions. All right, give us a sense of what's happening on the tariff economy.
So we selected here a quote from the JP Morgan's chief global economist, and you can read it here as well as I can. But the gist of their sentiment is that they anticipate, as do a lot of others, the slide in business sentiment to accelerate as we move through the year. The April tariff announcements, which I know have gone back and forth with some modifications, but I think the direction of travel with tariffs is clear and well understood and anticipated in the market. And over time, it's going to really weigh on business confidence. And this is happening at a time when the margin for error is smaller for businesses than it's been in a long time, with consumer sentiment dropping, whether you believe we're headed into a steep recession or already in a recession, or we'll just have a slowdown that we come out of sometime in late 05 or 2025 or early 26. Either way, there's going to be some disruption. And public companies have, as many of us know, been rewarded in the short term for taking cost out or for efficiently managing working capital and converting EBITDA to free cash flow. But what is going to drive sustainable shareholder value growth is the same now as it was 20, 30, 40 years ago. And that's sustainable revenue trajectory and revenue growth that can be delivered profitably. So I think it's very timely to have this discussion because we have a bit of a shock coming, or we're already in it. And I think we can spend some time talking about what are the tools that businesses can use to really help manage that.
So it's an interesting comment that you make, right? Businesses are rewarded for the basics.
Yeah.
Be profitable and grow, right? And grow profitably on a consistent basis. That's correlated to stock price, but it doesn't always necessarily, stock price, as we know, doesn't correlate to always what's going on in the economy. About 60% of Americans, in fact, invest or have some investment in the stock market. That's a whole 40% that don't. So as we think about it from a consumer perspective, how it is for the customers versus how it is for the business leaders is a completely different situation, or certainly a different lens. It can be a similar situation, it can be different. I'm wondering in this particular case, and we'll explore it a little more, especially what we found in the data of how different it can be viewed, right, from a consumer lens, and quite honestly, by different types of consumers, right? So as you think about it, um, socioeconomically or positions that they're in. And, as I was alluding to, the news is everywhere about it, right? And the other thing, in talking to a number of executives myself, I can tell you that everyone is talking about how to adjust pricing. The issue is some of them are actually doing it in advance before the tariffs have even hit. They were doing it to understand how consumers are going to respond. There's some challenges related to that. We'll talk about that in a few minutes. But it seems to me, I'd like to get your, perspective on this. Why would companies be raising prices when they don't have to? That's a question that hit me right off the bat.
Yeah, I think it is what we've seen in other industry sectors as well as retail is people look ahead and they discount back to the present those decisions. So if they see that there's a window before a dramatic softening in demand for them to capture that that excess profit, they will pull forward some of those decisions. Now, if not done nimbly and with precision, there's risk in a decision like that. But they may be trying to capture some revenue growth if it's a public company, perhaps exceed analyst estimates for a quarter or two and kind of ride that. But there's the potential for that to be short-sighted if it alienates the customer base or creates negative sentiment that can be hard to dig out of.
And that's clearly one of the findings. It's curious you mentioned that. That's exactly one of the findings that we show. The risk of alienating consumers who, already are distrustful. We've already established that companies are, for lack of a better term, trial ballooning pricing. Um, and I'm struggling with it personally, to be honest with you, because they're actually doing it in the market, as we saw in some of the headlines previous slide. But that has happened even in the advent of before the tariffs have hit. And retailers are announcing Q1 results. Some of them are exceeding expectations quite heavily, and that's great. The reality is, is that on the back of consumers? Is that on the back of, for Americans, the average family of four that's still struggling with prices and wage increase, deceleration compared to price increases?
Yeah,
Uh,
related to that, I think it calls back to something we were talking about a few minutes ago, which is some of those positive surprises that we've seen, albeit with kind of lowered expectations going into the earnings releases. There is a question about how sustainable that is. And it gets back to what we were talking about, which is that maybe people are grabbing and trying to pull forward some of the demand they think they can capture or the additional revenue they can generate while they can. But I think it has the potential to have a consequence downstream that may be hard to climb out of.
Yeah, that's exactly right. And, some of our friends in the supply chain world have already told us, look, people are pulling in orders, trying to get them in pre-tariffs. This is all very, in some ways, agile, in some ways, overreactionary, in some ways, anticipatory. Are you pulling in an order now, going to capture the revenue, and then not make it in the second quarter of the year? trading off one quarter for another. Um, in and amongst all of this, what's the long-term strategy for a company, right? I mean, it is important to be agile. That's true. But as we think about it, this is happening, as you can see, prices are being raised around the globe, number one, which has an implication in the long term that there isn't going to be a cheap place to make stuff, right? And buy it and ship it. And we got to think about that and how are companies addressing that in their longer term strategy. So price and demand are direct, has a relationship.
Yeah, I think when you talked about long-term strategy, I think one word that is essential to a strategy that's durable is sustainability, and by that I mean sustainability of a business model. And a person who I worked with in the past, who was a bit of a mentor to me, once said that any company that isn't on a growth trajectory or profitable growth trajectory has an expiration date. That company will die. It will cease to exist. So I think companies are, and meanwhile, business cycles are compressing at a rate that we've never seen before. So having intelligence and being able to redo your analysis and market check on an almost continuous basis is going to be a core capability.
Let's take a lens. We listen to it all. Sometimes we are in a little echo chamber here of business people, and then you go out to the consumer. And I remember uh, Richard Marcus telling me a story about his dad, Stanley Marcus, and he said, I mean, he founded, or ostensibly founded Neiman Marcus, a great company, great retailer, and how he would say, you got to spend time on the floor listening to your consumer. Um, I think we lack that across the board, even though we could, in almost every industry. And here's some of the things that we're seeing. It's not unusual or shocking from my perspective, but I think if you just hear the narrative of the story of this, it becomes pretty dramatic. First step, they don't really trust the retailers and brands. Um, they're not buying the story. First of all, where do they believe the increase in tariffs are coming from? And this is a large set of consumers. We're not talking about one, two, 500. We're talking about thousands of people here. And in models that have been shown to be very accurate, they don't believe that it's being generated from retail. And then they also believe that the retailers and brands have benefited from moving that manufacturing all over the place in their margins, and they feel that they should be able to eat the increases. And are they right? The question is, they're going to be right no matter what. They're going to decide whether or not they want to buy products. That's what the decision will really come down to. And I think the companies that are going to be most successful are going to have built a trust with the customer in difficult times. Because, as you stated, in this tariff economy, you gave I think a great assessment of where the economy is from a business perspective, right? But from a consumer perspective, I'm not sure it's completely aligned, especially not across the average. And so consequently, and we're seeing this in the luxury market, and we're seeing it in the mid market, and we're seeing it in almost everywhere. And you would say, well, okay, they're shifting it into off-price markets and whatever. I would challenge every listener to this webinar to go and do an exercise and look at your company or any company in retail or brand over a 10-year time horizon as of today and the S&P 500 index average return. And to be honest with you, Jim, I've done the work. I have yet to find one company that's outperformed the S&P 500. I'm sure there's one out there. I'm sure there's a handful of them out there, but they're not the off price. They're not other companies. And the reality is what the consumer is saying is the value you're delivering, because if that were the case, these businesses would be growing faster and being rewarded in the S&P 500 index. Either that or all of their success is going into somebody else's pocket other than shareholders.
You said something there that about you said, of course, they're right when you were talking about consumers. And that makes complete sense, right? Because in aggregate, the consumer population is going to determine who succeeds and who fails among the retailers in aggregate. That is the market. But it's interesting what you shared about the performance of retailers, publicly traded retailers relative to the market. Question for you is, do you think it's possible for a retailer to sustainably outperform? And if so, what do you think it would take for them to do that?
Oh, well, I hearken back to a very simple exercise in Warren Buffett's quote, right? And Warren Buffett said that when he passed away, that his investments that would be in control of it for his wife and family would be invested in an S&P 500 index fund because he was the exception rather than the rule of being able to outperform it, which is true for Berkshire Hathaway, right? Um, and that's because he's creating value. And it's going to come back to that same word, value, Jim, in my opinion. The companies that can deliver a product or a series of products and services or a series of products, services, and experiences that have a greater value than the payment that is made. I think that simple quotient, right? It's very simple. It's like the PE ratio in a stock market exceeds the average, which in many cases it's not. And the reason you see that is because it's hidden in markdowns, it's hidden in vendor allowance dollars, advertising. So, in order for a company to do what you'd just stated, in my opinion, they're going to have to create not only a sustainable business model, but they're going to have to do it in a way where the consumer values the product or services that they're offering so greatly that they're above the average. So they've got to figure it out. We as an industry have a responsibility to figure out how to serve the customer better. And it has to start with the fact that, hey, look, jacking up prices randomly and then trying, not even randomly, it's a pejorative statement. Raising prices is going to lead to a huge disconnect between the consumer and the retailer, right? So let's move on to the next data set that we found, right? Price empathy. Um, Probably, I think, one of the most challenging emotions that exist in humanity, empathy. Basically, what consumers are saying is that they believe that companies that absorb the pain related to the price increases that may occur or may not occur are going to build loyalty and empathy, or loyalty through empathy. Kind of makes sense. If you're trying to build a long-term relationship, there's going to be ups and downs. And this is going to be one of those periods of times where we're going to see how consumers are going to respond. You can see it varies by country, but honestly, it seems to be across the board. Um, the other thing is loyalty is waning, and the inverse, right? I don't find this shocking or surprising at all. Our data over a number of years now have indicated that customer loyalty related to brands, retailers, etc., um, really is the transaction cost of moving. And that's unfortunate in many ways, but it really is an interesting dilemma that it represents to a company or brand is if they can create a great product or experience or a package for that consumer, they're going to come back. And that's about the extent of the relationship and the loyalty. Um, it fundamentally indicates as well that they're only willing to pay so much. Key element that you brought up earlier on is, boy, is there a way to pinpoint it and understand where and how? Let's talk about that in just a half a second. Price sensitivity is real for sure. As you can see in some of the data that's showing here, consumers can't absorb it anymore. And there's a real ceiling that a number of people are going to hit and what they would consider as acceptable and not. And I will tell you that the question then begets, if you have to raise the price but it comes down, are you going to be as responsive?
Yeah,
How
what's interesting about that is I think it's instructive to see those numbers at a point in time. And it's even more instructive, of course, if as it gets more granular, maybe down to the product level. What will also be interesting to see is how it's changing over time.
So are retailers doing something about this? Well, in fact, they are. Um, Remember, our data collection included several hundred retail executives and brand executives. And it indicates in all ways, shapes, and forms, and I've even confirmed this through personal conversations. They're pulling in inventory deliveries. That's the first point, right? 48% or more than half, which is kind of interesting. I think it's robbing the second quarter to save to increase the first quarter, even though they may not bring the goods to the floor. They're going to hit there eventually in some way, shape, or form, holding costs related to it. The whole issue related to supply chain of doing that, a bit premature, perhaps, raising prices. Again, don't understand why people are raising prices. I understand they need to know how people are going to respond, but I think that there's ways around that that we're going to suggest that are better than doing it, actually physically pulling the trigger and making it happen and having the impact to people when they're actually going to, you know, feel the impact that they don't need to. And then private label, which is something we've advocated all along. Vertically integrated retailers and vertically integrated brands, and the more vertically integrated you control it, yes, it's a bigger risk, but it's a greater reward as true as well. And consumers, this also speaks to the fact that they're willing to trade off, right? I've written a couple of pieces on Forbes recently. Go back and take a look at them on Traders, Joe's, and Aldi's. By the way, most people don't know those are related companies. It used to be Aldi North, Aldi South, right? Funny story there, but private brand is a huge impact, and people are willing to. And that company is growing and adding stores. So I think the idea of illustrative image, brand imagery being able to carry a price, yes, certainly so, as part of the value equation. But it's clear that consumers are willing to trade that off, and it doesn't necessarily always have to be in a value conscious period of time.
Yeah, the evaluation of private label or proprietary brand is it's analytically very rich because there's not only a price elasticity element, there's a margin implication and there's an inventory and therefore working capital implication. It can really impact a company in multiple ways. And so I think it really plays well to a sophisticated platform that can robustly evaluate it.
Let's talk a little bit about how some companies are addressing it through technologies like First Insight and our organization. You know, you can see three examples here that are outlined as far as anticipatory pricing and understanding. So I often ask people, what would you do differently if you knew what the price elasticity of a product was in advance of even selling it? I'd re-engineer it. I could cost contain it. I could add pricing, increase pricing related to it. There's a whole host of control factors. The key point between our organization, First Insight, and the balance of the tech world related to this capability is we're about anticipatory, not just forecasting, but accurately being able to help you understand by segmentation, by area, and not just for price adjustments, for initial price setting, long life cycle items, short life cycle items. I remember years ago, I think it was 2017, we were working with a company in the European market, and they said, this region of Europe is, very price sensitive compared to the other regions. And we said, all right, well, our data shows it because items haven't sold. So traditionally it's, X percentage lower than our average baseline. Well, what we were able to find out is in certain segments by region, we were able to increase prices, and to your point. And what that led to was a double-digit impact to their gross margin percentage in that region. And that's the way the power of computational modeling, as you know, and analytics from your experiences in finance, it's the ability to collect all of that and then accurately pull it off in a model, right? But also in a store or in a region.
Right. I will tell you that I spend a lot of my career trying to anticipate um, the impact of certain decisions on the way companies would be valued, say in the public markets or in the context of an M&A transaction. And if we could get to a regression analysis that would have a correlation or an R squared, for those who understand that, would of oh 0.25 or zero point 0.3, we thought we had a pretty robust way of evaluating the impact of a move on an outcome. But one of the reasons that I was attracted to First Insight is because of the predictive power of the engine of this platform. It far exceeds what I've seen elsewhere consistently, and I think that ability to offer uh, companies who work with First Insight confidence to know that if they follow the signal in aggregate and consistently, they're not they're not necessarily going to be making the right step every step of the journey, but they will be on the right path in aggregate. And
And,
that's super valuable at a time like this.
over my experience in the 17 years of the company, we've been able to replicate that in every product category, right? Whether it be in fast fashion, apparel, accessories, handbags, shoes, luxury goods, automotive, restaurants, quick service restaurants, you know, cruise lines. I mean, it's fundamentally humans behave, and the model is able for us to be able to identify a very clear approach that is replicable and sustainable. And I think it's a competitive advantage. So thank you for that testimonial. But so let's take a look at this company. This is by a product category. They raised the prices across the board and essentially had a loss in revenue. And you'd say, well, of course, increasing price and will decrease demand. That's not true. It's not an accurate statement. Adam Smith wrote that book, The Wealth of Nations, a couple hundred years ago about the economic theory of supply and demand. But we have example after example of companies who have raised prices categorically within a season 3 times and not degraded demand. So what it is the value quotient or the relation to the product and the price are very tied. And what that means is it drops off. Price elasticity isn't a single data point. It changes and it actually is very dynamic at different price points. But the question that we have to ask ourselves is what if they had the ability to understand it, as you can see maybe in the lower right here by generation. And you can see in this illustrative example, their ability to say that that product with Gen Zs who are targeting aren't going to accept a price increase. But they will on the other shoes and certainly on the top shoe in this case. And it can be optimized for different ideas, whether they're trying to generate sales or margin or penetration, reach. At the end of the day, I think this example is brought to you with the intention of showing that, number one, you don't have to test it on consumers in the market, which means a cost of making it, bringing it to market, potentially even offending them, right, by raising prices. Or if it's already in the market, you don't need to raise it. There's ways to get this data, simulate it, and present it back to the decision makers in a very accurate way, to use your point about regression analysis. And I think this kinds of sensitivity analysis is being done a lot. It is what AI was really built for, right? Is being able to understand all these computational perspectives and seeing, making or being able to make a recommendation on an approach.
Right. It's the combination, I think, of the speed with which it can be done and the agility of the analysis, the ability to modify it uh, before a lot of capital has been used to perhaps build out an inventory or a prototype and test it, and the accuracy. So if you have all those three of those components together, which is, I would say, far in excess of anything when I was building insights in a different context, far exceeds anything I'd ever worked with. So yeah, I agree with you.
Well, so then let me ask you a question that has perplexed me for years. I mean, I'll be honest with you. Why wouldn't somebody do it? Why wouldn't somebody run simulations like this on an ongoing basis? It seems like literally a no-brainer.
I It does seem like a no-brainer, but it's a funny thing happens on the way to fully leveraging data, I think. Bias and behavioral patterns get in the way. And the bias that I think I've seen in multiple industry sectors, I'm not singling out retail, but it's present in retail, a bias of belief that intuition and insight is in a person's individual instinct could um, outweigh the wisdom of the large group that they're polling. And so sometimes it's tough to reconcile those two. And I think that maybe that gets in the way. I'm just speculating here, but I'm just basing it on behaviors I've seen among decision makers at companies across multiple sectors. And by the way, I don't want to categorically say that instinct, there's no place for instinct or intuition because as those of us who which is probably virtually everyone who's watching this and you and I who are users of AI every day, multiple times a day, I think we know enough to know not to rely solely on something that comes from an AI. However, the combination of AI and human computational capabilities or experience is is unbeatable, I think. Yeah.
So one last thing to think about. This is a dashboard rendering of managing risk across the continuum and an idea about how to approach that risk mitigation in data. And so when we can begin to see correlations between the data on a continuum scale of risk, as you know, in the financial community, that I think it's called if my graduate school studies served me right, the efficiency frontier.
Yep.
Um,
Dear.
it allows you to look at risk and reward, right? And we're all making those decisions. I think what we've been able to render here is the ability to take that at a product level and roll it up and allow key decision makers, C-suite executives to say, yeah, it's time for us to take a more conservative approach or a more aggressive approach, whether it be in sales or margin or others, and be able to model that in a forward-looking view that is proven um, instantaneously, right? So speed is a competitive advantage, and accuracy, as you said, is another competitive advantage. I thought you mentioned both of those earlier in the webinar. Here's where we're talking about control mechanisms that actually can give you the levers to predetermine the destiny of the organization as opposed to becoming the reporter of the outcomes. So with that, I want to thank you for your time. I know it's been enjoyable from my side of the conversation, and always enjoy our conversations on these topics. Any last thoughts that you might have related to how the audience might take this all the way?
Yeah, I would say, first of all, I appreciated the chance to have this conversation in this forum. It's been great. I would say, as I see it, there are certain essential capabilities for retailers as well as companies in other industry verticals, be they consumer packaged goods, grocery, automotive, quick service restaurants, healthcare, pretty much across the board, anyone who sells a product or a service. For these companies, some essential capabilities that relate to decision making platforms. And I did mention it. I talked about speed, agility, and accuracy. I think when it comes to speed, it's about quick insights. Uh, when timely decision making has never been more important than it is now, because market demand is shifting at an accelerating rate. Business cycles are shortening. So this evaluation, I think, it's the natural limit to it is that it's going to be an ongoing exercise, not something that's done episodically. And then with respect to agility, I think about that in terms of the ability to really pivot quickly while maximizing the use of precious working capital. And likewise, that environment is rapidly changing as well. And we talked about accuracy, but any solution or decision-making aid that is proven to be highly predictive, that does offer that certainty in an increasingly uncertain world, well, companies have less margin for error than they've ever had, I think, is something that's quite valuable. So, yeah, that's my takeaway from it.
So speed, agility, and accuracy.
Yes.
You sound like you're coaching me through my next race that I'm going to be having. I'm going to add a component to this as we conclude. just to wrap it up, because I think your three are critically important. I wrote a paper in 2006 that was published that said we ought to move manufacturing closer to the demand signal. And it was predicated on supply chain thesis that the cost implications of that are far outweighed by the nimbleness and the accuracy of your ability. And so speed, accuracy, and agility are all controlled, right, by the dimension of time from and distance from where things are placed from demand and supply chain basis. So when lead times are 18 months, 6 months, 9 months, and everybody's trying to shorten them, it still takes time. Last time I checked, boats only go so fast across the ocean. Yes, you can do planes, but reality is, I think everybody in this conversation ought to contemplate the idea of the signal of demand and the ability to support it through supply in a very short cycle, contemplating the idea of bringing manufacturing close to that signal. Zara has been proving that model out for a number of years and quite effectively. So, well, I want to thank everybody for joining us today and wish everybody well and good luck. And as Jim suggested, we here at First Insight will take a lens at looking at doing this study into the future so we can have a couple of data points to start to draw some lines of what actually is happening from a consumer lens perspective. Thank you, everyone, and I hope you have a great day.